Today we're doing a complete breakdown of ASC 730. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Companies used to obscure R&D costs, leaving investors in the dark. ASC 730 changed that, ensuring transparency by requiring these expenses to be expensed immediately. Imagine a biotech firm spending $100 million on research without this clarity. After this section, you'll grasp how ASC 730 ensures investors see where innovation dollars go. ASC 730 was introduced to resolve the inconsistent handling of R&D expenses. Before, companies had the option to capitalize these costs, which often distorted their financial statements. By mandating that all R&D costs be expensed immediately, ASC 730 ensures accurate representation of a company's financial health. This change allows investors to better assess a firm's innovative endeavors and potential future growth. ASC 730 applies universally to any entity involved in R&D. It came into effect for fiscal years starting after December 15, 1974. The key requirement, expensing R&D costs as they're incurred, prevents deferral into future periods, ensuring immediate reflection in financial statements. This mandatory expensing gives a true snapshot of a company's current financial commitment to innovation, crucial for investors' decision-making. Under ASC 730's R&D expense model, research costs are expensed as incurred, emphasizing the uncertainty in R&D activities. This immediate expensing helps maintain financial statement accuracy and transparency. For interview scenarios, knowing how this model impacts financial analysis can demonstrate a strong understanding of both innovation valuation and accounting practices. The model ensures stakeholders see the real-time financial impact of R&D initiatives, fostering informed investment decisions. Getting the scope right is crucial. Candidates often forget that costs incurred for marketing activities are not covered by ASC 730. And that's a classic interview trap. Understanding these boundaries can make or break your compliance with the standard. It's not just about what's included. Exclusions are equally critical for accurate financial reporting. ASC 730 applies to costs directly related to research and development activities. Imagine a pharmaceutical company investing in laboratory research to discover a new drug. These costs are within ASC 730's scope. Even developing a prototype for a new software, intended for internal use as part of a larger R&D project, falls under this standard. Understanding what's included ensures accurate financial reporting of R&D expenses. ASC 730 specifically excludes certain costs to maintain its focus on true R&D. For example, any routine efforts to enhance existing products are not included. Marketing expenses, even if indirectly related to a development project, don't qualify under this standard. If a tech firm is simply updating existing software without a significant R&D angle, those costs are excluded. Recognizing these exclusions helps avoid misclassification in financial statements. Research is the heart of innovation, focusing on systematic investigation to uncover new knowledge. Take a tech company exploring quantum computing. Their theoretical analysis and lab experiments to understand new algorithms fit into research under ASC 730. These activities aim to push boundaries, setting a foundation for practical development. Understanding research's role is essential for identifying which expenses qualify under the R&D framework. Development is the application of research findings into tangible outcomes. Imagine a car manufacturer applying new fuel efficiency research to develop a hybrid engine. This phase includes designing and testing prototypes, ensuring they are commercially viable. By bridging theoretical research with practical innovation, development completes the R&D cycle. ASC 730 supports this by capturing relevant costs, guiding companies in recognizing when to capitalize versus expense these efforts. Edge cases often trip up candidates. Consider upgrading existing software purely for efficiency. These costs fall outside ASC 730, classified as maintenance. Testing new marketing strategies, also excluded, as they're part of selling activities. However, developing new internal software specifically for R&D purposes would qualify. Understanding these nuances ensures accurate financial reporting and helps avoid costly missteps. Clarity on these edge cases is essential for thorough compliance. Ever wonder how companies like Pfizer or Tesla handle their massive R&D expenses? ASC 730 provides the roadmap. By guiding the allocation and disclosure of research and development costs, it ensures transparency and consistency in financial reporting. This model is essential for investors and stakeholders to understand a company's commitment and strategy toward innovation. The research and development expense model under ASC 730 systematically categorizes costs associated with R&D activities. Let's consider Meridian Corporation investing $5 million in an AI project. We'll explore how this model guides them in identifying, managing, and reporting their research and development expenses, ensuring compliance and transparency throughout their financial statements. This journey reveals the crucial steps from initial cost identification to final disclosure. Meridian Corporation must first pinpoint costs directly tied to their AI research, such as prototype creation and initial tests. They can't include overheads or unrelated expenses. This precise identification ensures they accurately allocate research expenses from the $5 million budget. Missing indirect expenses can lead to overstatement, so ASC emphasizes careful distinction. By the end of this step, Meridian Corporation has accurately classified $2 million as research costs. With research costs identified, Meridian Corporation now isolates costs related to developing their AI into a viable product. This includes software refinements distinct from initial research activities. Distinguishing these stages prevents misallocation. Many confuse development with research, skewing reports. ASC clarifies this boundary, ensuring that by step 2, $1.5 million is accurately allocated to development, setting the stage for step 3's capitalization decision. Meridian Corporation now evaluates which development costs can be capitalized, focusing on those offering future economic benefits. This requires assessing technical feasibility and market potential. Misjudging here can lead to understated assets. ASC guides this decision, ensuring only costs meeting strict criteria are capitalized. For Meridian, $1 million of development costs meet these criteria, transitioning into the journalization phase in step 4. Now, Meridian Corporation translates their classifications into journal entries. They record $2 million as research expenses and capitalize $1 million in development costs. Accurate journal entries are crucial, as errors here can lead to significant financial misstatements. ASC 730 requires meticulous documentation to reflect true financial health. By completing this step, Meridian sets the foundation for transparent financial disclosures in the final step. In the final step, Meridian Corporation must ensure transparency by clearly disclosing their R&D expenses in financial statements. They report $2 million as expense and $1 million as capitalized development, providing stakeholders with a clear view of their innovation investment. Vague disclosures can obscure financial realities, so ASC stresses transparency. This comprehensive disclosure allows investors to understand Meridian's strategic focus on innovation, completing the R&D expense model journey. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 730 guides how R&D expenses should be recorded and disclosed, ensuring stakeholders grasp the full picture of a company's innovation investment. ASC 730 requires R&D costs to be expensed as incurred unless they meet specific capitalization criteria, like technical feasibility. This ensures costs reflect the true stage of project development. For instance, materials with future uses are capitalized, impacting the balance sheet positively. Recognizing these costs at the project's start ensures accurate financial timing. Under ASC 730, R&D costs are continually expensed unless there's a fundamental change in project conditions. This prevents overstating assets by avoiding revaluation. If capitalization criteria fail, costs revert to expenses, ensuring transparency. For example, a shift in project scope might alter capitalization, requiring careful reassessment to maintain reporting integrity. R&D expenses show up as operating expenses, impacting the income statement directly. Capitalized R&D costs, though rare, appear as non-current assets. This difference can sway key financial ratios. Detailed notes on R&D activities inform analysts about innovation priorities, providing a deeper understanding of a company's future potential and strategic direction. Disclosing R&D expenses offers investors a window into a firm's innovation level. Knowing the nature of these activities explains strategic priorities. Clear accounting policies ensure comparability across firms. Lastly, understanding R&D's financial impact helps predict future earnings, making these disclosures indispensable for thorough financial analysis. Imagine a CFO managing a $2 million R&D budget. Capitalizing $500,000 when feasibility criteria are met boosts assets, while $1.5 million impacts the income statement, reducing net income. Equipment costs of $150,000 with future use are capitalized. A project pivot might shift $200,000 from expense to asset, demonstrating ASC 730's flexibility yet precision. Meridian Corporation, a global manufacturing company, embarks on a groundbreaking R&D initiative for a potential new energy source. With a budget of $1,200,000, they aim to redefine their product line. Let's unravel how ASC 730 guides the accounting journey, capturing each financial move from inception to culmination. Under ASC 730, all R&D costs must be expensed as incurred. Meridian Corporation records the $200,000 as R&D expense, impacting the income statement directly. It underscores the speculative nature of R&D, ensuring transparency in financial reporting by reflecting the immediate cost impact without capitalizing on uncertain future benefits. While routine R&D costs are expensed, ASC 730 allows capitalization of equipment that has alternative future use. Meridian Corporation's $75,000 equipment is recorded as an asset, reflecting its utility beyond the current project. This judicious investment will depreciate over its useful life, spreading its cost across future periods. Per ASC 730, salaries directly attributable to R&D must be expensed immediately. Meridian Corporation's $120,000 allocation highlights the human capital investment in pioneering their energy project. This entry affects the income statement by recognizing the immediate expense, reinforcing the principle that R&D entails upfront risk and cost. ASC 730 mandates that supplies consumed in R&D activities are expensed as used. Meridian Corporation's $50,000 entry reflects the immediate financial impact, emphasizing the experimental and consumptive nature of R&D. This approach ensures the financial statements accurately depict R&D's cost intensity and inherent uncertainty. Recognizing expenses incurred but not yet paid aligns with ASC 730's accrual basis. Meridian Corporation's $30,000 adjustment reflects a commitment to financial accuracy, ensuring liabilities match recognized expenses. This prudent management of R&D costs aids in transparent reporting and strategic decision-making. Upon achieving technological feasibility, ASC 730 allows for capitalization of costs, transitioning them from expense to asset. Meridian Corporation's $100,000 move underscores a critical advancement, reflecting potential future benefits. This strategic shift balances immediate expense impact with long-term asset recognition. ASC 730 requires amortization of capitalized costs over their useful life. Meridian Corporation's $20,000 amortization entry ensures systematic expense recognition, aligning with the asset's expected economic contribution. This methodical approach soothes income statement impact, reflecting prudent financial stewardship and strategic asset management. The completion of an R&D project concludes the asset's life cycle. ASC 730 dictates derecognition once fully amortized. Meridian Corporation's $100,000 asset removal signifies a seamless transition from R&D to operational viability, closing the financial chapter on an innovative journey and opening new operational horizons. Every Big Four and investment bank interview on ASC 730 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 730 governs accounting for research and development costs. It ensures consistency by requiring costs to be expensed when incurred. This prevents capitalization, which could mislead stakeholders about asset values. Knowing ASC 730 helps you understand the financial health of a company's innovation efforts. Remember, R&D expenses impact net income directly. ASC 730 mandates expensing R&D costs to reflect the uncertainty in achieving future economic benefits. Unlike capitalized costs, expensed costs show immediate cash outflows, affecting profitability. This approach aligns with conservative accounting principles, reducing the risk of overvaluing assets. Remember, expensing R&D enhances transparency and reliability in financial reporting. If a project fails, research costs are still expensed under ASC 730. This reflects the inherent risk in R&D activities. Expensing ensures that all incurred costs impact the current period's income statement, providing an accurate financial picture. Avoid assuming that costs can be deferred; they must be expensed immediately. Under ASC 730, development costs are expensed, even if the project succeeds. This ensures comparability and transparency across financial statements. Unlike Indian Accounting Standard or International Financial Reporting Standards, ASC 730 does not allow capitalization. The key takeaway is to always expense these costs, regardless of project outcome, to maintain compliance. ASC 730 requires all R&D costs to be expensed, while Indian Accounting Standard allows capitalization of development costs under certain criteria. This affects how assets and expenses are reported. Misinterpreting these differences can lead to incorrect financial statements. Remember, understanding both standards is crucial for accurate cross-border financial analysis. ASC 730 expenses all R&D costs, whereas International Financial Reporting Standards allows for the capitalization of development costs meeting specific criteria. This can result in significant differences in asset values and income statements. Misunderstanding these distinctions may cause compliance risks. Memorize this to avoid errors in international financial reporting. To calculate the impact, subtract total R&D expenses from operating income. For example, if operating income is $500,000 and R&D expenses are $100,000, net income before taxes drops to $400,000. Mislabeling expenses can distort this calculation. Always ensure R&D costs are accurately categorized to reflect true profitability. A common mistake is assuming software development costs fall under ASC 730. However, they are covered by ASC 985. Misapplying ASC 730 can lead to incorrect expensing or capitalization. Always verify which ASC applies to avoid misclassification. This will ensure accurate financial statements and compliance. CFOs must disclose total R&D expenses on the income statement and provide a narrative on R&D activities in the financial statement notes. This transparency helps stakeholders assess the company's commitment to innovation. Misleading or inadequate disclosures can result in compliance issues. Always ensure disclosures are clear and comprehensive. ASC 730 addresses the financial treatment of R&D costs. It applies broadly, ensuring consistent reporting across industries. Key definitions distinguish between research and development phases. Routine testing isn't R&D. The objective is clear: guide entities in recognizing R&D expenses, improving financial statement comparability. Grasping these basics is essential for accurate application and compliance. In ASC 730, the core model mandates expensing R&D costs as incurred. There's no room for capitalization, ensuring expenses reflect actual outflows. Direct costs include labor and materials, while indirect costs cover allocated overhead. Measurement is at historical cost. Software development falls outside ASC 730, aligning under ASC 985. If a project is abandoned, all costs are immediately expensed. Interview topics around ASC 730 often touch on myths like R&D capitalization, strictly prohibited here. Disclosure of total R&D expense in policies is essential. Unlike International Financial Reporting Standards, ASC 730 doesn't allow capitalization, a key difference. Misclassification errors can lead to compliance issues. Understanding how immediate expensing impacts short-term profit is crucial. particularly in tech and pharma sectors. Clarifying what truly counts as R&D is a common challenge. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.